Hello again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Monday, June 22nd, 2020. We've got several topics to discuss today, so let's get right to it, and thanks for listening. This is an audio-only version today. As you know, we believe at Blanke, Schein Wealth Management that information is power, and our goal is to provide our clients, friends, family with real-time and relevant market-related information on a daily basis, and our process creates smart and purposeful decisions, financially speaking, that improve your life, your family's life, and the community you care so much about. So let's get right into our topics of the day, and thanks for listening again. My first topic of the day is yield curve control. Essentially, it's a tool that most recently our Federal Reserve Chairman Jerome Powell has announced that they are modeling and taking a look at and studying. Why this is so important and significant? Well, actually, the last time the Federal Reserve used it was in the 1940s. Okay, from 1940 to 1950. In fact, they kept the interest rates and the treasury yields cheap, extremely cheap. Essentially, they kept the yields on treasuries super cheap. Why? Because we had to fund World War II. So that policy actually extended all the way through the decade, and it ended in 1951. Now, it's impossible to isolate the impact, but I will tell you, we did go through Pearl Harbor in 1941 and the Battle of Midway in June of 1942. And what you found was, as the yield curve has been suppressed, and the reason why they do that is to keep rates artificially low to allow other sectors of the economy to catch up and to accelerate out of a recession, if you will. Okay, you're basically keeping everything funded and everything super cheap. Well, what happened? We had monster rally in equities at the time. So while the Federal Reserve is toying with this policy, we're seeing markets in anticipation of this potentially coming through, more negative headlines from coronavirus, possibly a second wave or hot spots across the United States. Keep in mind, that's only going to fuel positive for the equity markets. I know it's counterintuitive, but it also adds in the effect of the potential for the Federal Reserve to use these tools like yield curve control. We're going to talk more about that, but I think it's very important as the markets are paying attention to things that monetary policy have announced in their language over the last sort of month and a half or so. So we're going to continue to talk about it as markets are paying attention to it, and it moves markets. Again, 1940s, 1950s, Federal Reserve used it, and we had monster rally in equities, multiple expansions, and PEs expanded tremendously. So also U.S. home prices went up over that time tremendously as well. So let's continue to watch this and see how this plays out. So my second topic of the day is gold. Gold is a barometer as it relates to the negative headlines and the concern that is playing out with coronavirus, right? This is one of those things where we're in a recession right now, and gold is also a barometer for safety. Gold pushes towards its highest level since 2012 right now, lifted by concerns of a second wave of coronavirus infections growing and the uncertainty in Hong Kong after China released its details about the proposal of the national security law. So what's happening is gold is in a trading range at the moment amid virus concerns, but it's heading a 1750 level, which is the top side of a high. It'll be interesting to see if we stay in this trading range for gold as the pandemic grows, or the concern for it grows around the world, specifically in China and then around the world here in the United States. But right now we're at the high end for gold. And so if we pull back, I think it'll be a good sign that the virus itself is being controlled around the world, even though we're seeing hot spots break out. So let's keep an eye on gold. And my final topic of the day, the NASDAQ is on a record close today. So we just saw large cap, big tech companies continue this bull run, this resurgence. I brought this to the forefront at the very beginning of the pandemic. In fact, that's how we've positioned our client portfolios, is overweighting large cap tech, simply because we're pulling forward years worth of technology in this 3.5, 4 month period of time. Essentially the adoption, whether it be the consumer or more importantly, businesses, right? Business will not be the same going forward. So therefore we're going to need all that technology, whether it's work at home or, anything else that we see on a go forward basis. All that technology is going to be now integrated sooner than later. Therefore, if you believe it or not, we had a record close on NASDAQ today. It's a 7-day winning streak. It's the longest winning streak of the year for NASDAQ in 2020. And NASDAQ's up about 12% year to date. So it doesn't even act like there was a pandemic out there. And so that's why you have to, when we position portfolios, we look through sort of the headlines and we manage our clients' portfolios accordingly. And this is just one of those cases where, we do expect a pullback at some point in time, but that would just present an opportunity to add some higher quality names and continue to sort of increase our existing positions. So that's it for today. Thanks for listening. And if you have friend or family or somebody you want to, or just subscribe on a daily basis, please go ahead and do so. We appreciate you listening. Take care. Have a great day.